Hey everyone, welcome. If you own a janitorial business in California and you're maybe thinking about selling, you've probably spent countless hours staring at your profit and loss statements. But what if I told you the real secret to your company's value isn't just buried in those numbers? Today, we're going to break down how to value your janitorial business, the California way.
It's the million-dollar question, isn't it? You've poured your heart, your soul, and a whole lot of sweat into building this thing from the ground up. You know what it's worth to you. But what a buyer is willing to pay, well, that can be a totally different story.
And you know what? That's really the heart of everything we're talking about today. Yeah, your profits matter. Of course they do. But buyers in the Golden State, they're looking for something more. They want stability, they want reliability, and they want proof that your business is built to last. Why? Because that's what minimizes their risk.
So let's start peeling back the layers here. We're going to look right past the simple revenue numbers to see what a sophisticated buyer is actually digging into when they look at a janitorial business in California. Okay, this is such a critical distinction to make. So many sellers, they focus on showing off these huge revenue numbers or brand new floor buffers. But a smart California buyer, they're thinking about one thing: risk. They want to see stable, long-term contracts. They want to see happy clients who stick around. They want a clean legal record and a customer base that isn't going to collapse if you lose one big account. At the end of the day, stability trumps flashy profits every single time.
So, if it's not just about the profit, what are these other factors? Let's get really specific and explore the true drivers of value that can make a buyer see your business as a safe investment instead of, a risky gamble.
These right here, these are the 5 pillars that are going to support a top dollar valuation, and each one tells a story to a potential buyer. Recurrent revenue, that proves you're stable. Clean books, that builds trust. Compliance, that shows you're a pro. Market demand proves you're relevant. And a great online reputation, well, that's your modern-day curb appeal. We're going to touch on all of these.
And take a look at this, because it really highlights the importance of market demand. See, it's not just how much business you do, it's where you do it. If your client list is packed with office buildings and healthcare facilities, you're in high-demand, super stable sectors. A buyer sees this, and they know there's a strong built-in market for your services. That makes your business inherently more valuable from the get-go.
89%. Think about that for a second. That's how many people read online reviews before they make a purchasing decision. And yes, that absolutely includes B2B services. Your online reputation is no longer a nice-to-have. It is a core asset. Good reviews directly translate into trust and a higher value for your brand. And you know the flip side. One bad review can cost you a lot of business.
Look, I can't stress this enough, especially here in California. Buyers are going to do their homework. They will check your records. They want to see proof of safety training, anti-harassment training, full compliance with wage and hour laws, the whole shebang. Any hint of non-compliance is a massive red flag that just screams future lawsuit, and it can tank a deal so fast.
All right, now for the part you've probably been waiting for. We've talked about all these soft factors, but how in the world do they translate into a hard number? This is where we get into the actual math that buyers and brokers use to put a price tag on your business.
The starting point for almost any small business valuation is something called seller's discretionary earnings, or SDE. Just think of it like this. It's the total cash-generating power of the business for a single owner. It's your net profit, plus your own salary, any personal perks you run through the business. It's the true bottom line.
And this chart, it just lays it all out perfectly. This shows how everything we've talked about comes together. A business that's super dependent on the owner, with shaky handshake deal contracts, it might only sell for 1 to 2 times its SDE. But a business with strong, documented contracts and clients who stick around, that can command a multiple of 3.3 times SDE or even higher. It's the same earnings, but the quality and defensibility of those earnings make it worth nearly double.
Okay, so you get it, but what can you actually do about it? Knowing what buyers want is one thing. Now, let's look at the concrete steps you can take, starting today, to strengthen those value drivers and get your business ready for a top dollar sale. So, here's a basic roadmap you can follow. First, you figure out your true earnings, your SDE. Then, you look at what similar businesses have actually sold for to find a starting multiple. Next, and this is so key, you adjust that multiple up or down based on your business's specific strengths and weaknesses. Finally, you add in your hard assets and then do a reality check against what a bank would actually lend a buyer to buy it. So you want to boost that multiple? Of course you do. Here are some real-world examples. Bringing in tech like GPS tracking, that shows you're efficient. Employee recognition programs, that reduces expensive turnover. And strong supplier relationships, that shows you're smart about managing costs. Each of these makes your business a more attractive, well-oiled machine.
Listen, if you only take one thing away from this whole explainer, let it be this. Go through your client list and formalize every single relationship. A handshake agreement is basically invisible to a buyer, but a signed, multi-year contract, that is cold, hard proof of stable, predictable income. And that is the single most powerful asset you can have when you go to sell.
All right, now let's flip the script. It's just as important to know what not to do. Let's cover the most common and, yeah, costly mistakes that can absolutely crush your valuation.
This is the #1 trap for sure. You've invested years of your life, right? All that sweat equity feels incredibly valuable to you. But a buyer doesn't pay for your hard work. They pay for future cash flow. You have to find a way to separate your emotional attachment from the objective, market-based factors that really determine the price.
Now, what's really interesting here is the psychology. Some sellers think, hey, I'll just ask for a super high price and we can negotiate down. But in the real world, an unrealistic price doesn't start a negotiation. It ends the conversation before it even begins. Serious buyers just get turned off and move on to the next opportunity.
Oh, this is another huge one. You might know your numbers inside and out, but if your financial records are a shoebox full of receipts and a spreadsheet that only you can understand, a buyer just sees chaos. It immediately creates distrust and makes them wonder what other problems are hiding under the surface. You gotta understand, messy books aren't just a headache, they are a total deal killer. Here's why. If a buyer can't verify your income, they're not gonna believe it. If a bank can't make sense of your financials, they won't finance the purchase. It screams a lack of professionalism, and it will stop a deal dead in its tracks. Clean, transparent records are absolutely non-negotiable.
And that brings us back home to California, right? You can't just cross your fingers and hope a buyer won't notice if your employee files are incomplete or you haven't kept up with training requirements. Oh, they will notice, and they'll see it as a major liability they would have to inherit. And that will either dramatically lower their offer or just cause them to walk away completely.
And that really is the bottom line, isn't it? Anyone can have a good year. But a truly valuable business can prove that its profits are stable, that they're protected by contracts, supported by happy customers, and compliant operations, and that they're likely to continue for years to come. That is what a buyer's really buying.
So, I'll just leave you with this question. Forget trying to do everything at once. Based on everything we've just covered, what is the single most impactful thing you can do tomorrow to make your business stronger, more stable, and ultimately a whole lot more valuable?